Hi, Ken Boy with Accounting Accidentally. This video is called Amazon Drivers, AI, and Labor Cost Variances. So Amazon is using AI to schedule deliveries, and they give you a little history here. When Prime was launched in 2005, two-day shipping was unheard of. 2019, one-day shipping was occurring. So Amazon is getting faster and faster. And now the retail giant is using generative AI to drive more same-day shipping. I was amazed at this number. This official at Amazon told CNBC that 60% of Prime orders in March were delivered the same day. That's an amazing statistic. So they're getting better at it by using AI. As AI makes Amazon more efficient, they can deliver more packages in less time, and this is going to have an impact on the costs that they budget for delivery and their actual costs. Okay, let's use Amazon delivery costs to explain variances. A variance is defined as the difference between budgeted costs and actual costs. And there's two reasons for these differences. I think this is really important and not explained well enough in accounting. You pay more or less than you planned as a price variance. You use more or less than you planned as an efficiency variance. Think about a recipe. If you pay more for the ingredients, that's a price variance. If you use more ingredients than what's in the recipe, that's an efficiency variance. So here's my example. The budget is the Amazon driver earns $20 an hour. They are expected to deliver 50 packages in 5 hours. What actually happens is the Amazon driver earns a little more, $21 an hour rate. They deliver 50 packages in only 4.5 hours because of the use of AI. So the first thing we have is a labor price variance. Now for quantity, remember that means hours. Actual quantity times actual price, actual quantity times budgeted price. So we use actual quantity in both formulas. The difference is in the prices. So if I multiply across and click on the result, I see that I have an unfavorable variance, meaning that the actual was more than budgeted. And that's because the actual rate was $21, the budgeted rate was 20. It's an unfavorable variance. Actual was more than budgeted. In an efficiency variance, actual quantity times budgeted price, budgeted quantity times budgeted price. Like the formula above, we have two of the components are the same in both formulas. So the only difference is actual quantity versus budgeted quantity. Because of AI, we only took 4.5 hours to deliver the packages. We had budgeted on 5 hours. So this is actually a favorable variance because we used less hours than we thought, 4.5 versus 5 budgeted. So it's a favorable variance of 10. And then what you can do is add up and find out the total labor variance, which is the combo of the two formulas. And you can see that it is a net favorable variance because the hour savings more than offset the additional dollar per hour that we paid the individual. So even though we paid the individual a higher rate per hour, the savings in time gave us a favorable variance overall. So that is a labor cost variance. The takeaway here with variances for labor is we have price variances and efficiency variances. And what we saw was even though we paid a higher rate per hour, the hourly savings from AI were more than enough to offset the higher rate we paid for payroll, resulting in a favorable variance.